Welcome to the Wall Street Crossover Show, brought to you by Tip TV in conjunction with our sponsors. Who are we today? We're Admiral Markets. It gives me great pleasure to reintroduce Mr. Darren Sinden, market commentator for Admiral Markets. Darren, how the devil are you?
Yeah, very well, thank you.
I'm almost lost for my voice there. In terms of the markets, obviously a long bank holiday weekend for Tip TV, so we missed a trading day. Obviously, Wall Street down 1% at the close last night. Yeah. Sort of headlines: the Spanish regional elections, Greece. Are these problems ever going to go away, or are they going to get solved, in your humble opinion?
Well, just leaving the office, reading another headline about Greece. Don't hold your breath for a decision about that today, certainly, and possibly not by the end of this month. Either. I think that's going to roll over into June and probably to this IMF repayment deadline, which they've already said they probably can't meet. So no, that's going to continue and probably get worse before it gets better.
Understood. Okay, well, we've got a number of slides to go through. Let's kick off with the first one. Data released over the European session. What's caught your eye this morning?
Well, quite quiet as far as actual data for Europe was concerned, but we have had a couple of bits of consumer confidence data. So, first of all, from Germany, the GfK consumer climate. Now, this is a forward-looking number. This is the forecast for June. So, the reading today, 10.2 versus the 10 figure that the market was expecting. Basically, with all these consumer confidence numbers, the higher the number, the better the outlook.
Right.
So that's an improvement, and it's also not only an improvement on the forecast, but a modest improvement above the similar read for May. So positive sounds coming out of the German consumer, at least by that measure. But if we move to a more backward-looking indicator from France, the French consumer confidence for May, we had a read of 93 versus the forecast of 95, and the prior read of 94 in April. So that's the first sort of bit of negative data we've had from France in the last 2 or 3 weeks.
We saw good GDP or manufacturing numbers, didn't we?
Yeah, they've been pleasantly surprising us. So that's a slight hiccup. But so again, with all these things, we can't take
one piece of data.
Nonetheless, that 94 and 93, a declining number, and the miss of the forecast. So that is worth thinking about, and probably showing in the euro dollar rate, which we'll look at a bit later. The key thing probably is going on in Europe today is the G7 finance ministers meeting that started in Dresden, in what was once Eastern Germany. Obviously a big agenda for them, things like terrorist financing, how can we combat that? Obviously Greece will be on the agenda, as will the Ukraine, and one or two other things, and probably doubtless many other topics being discussed on the sideline. There'll doubtless be a communique from them later on, probably not necessarily going to be any market moving news in that, but just to get an idea of sentiment of what the leading politicians of the world are thinking.
Understood. Okay, so let's move on to the FTSE 100 movers.
Well, I picked on a couple of stocks here that caught my eye. Weir Group, down 1.7%, but have had a very good run over the last week. They took a positive move on Tuesday after the Baker Hughes rig numbers out of the States showed at least not a tail off, but a slowing decline in the number of rigs active in the US markets. And for those that don't know, Weir make pumps and valves that are specifically used in the oil and gas industry. So any improvement there is good for them. So they've had a good run, but brokers are saying they've run far enough for now, and there are 2 or 3 notes with either a hold or a sell type recommendation, saying this is it for the moment, boys. But perhaps buy on the dips, but don't chase them here. And in terms of my second stock, EasyJet, up 1.6% on the positive move, benefiting from IAG, the owners of Iberia and British Airways bid for Aer Lingus, which was relaunched, if you will, this morning after the Irish government agreed to sell their 25% of Aer Lingus to IAG. One thing that surprises me about that deal is I remember Ryanair were prevented from buying Aer Lingus. I'm not on competition grounds. It's not clear to me why IAG should be allowed to pursue a bid themselves. Maybe the competition commissions will have a look at that. Nonetheless, that's a better sentiment towards EasyJet. They're at 1.86%, probably on valuation grounds, if nothing else. And obviously, you may recall that Ryanair had some good numbers earlier in the week as well, although that should have contrasted perhaps with EasyJet's poor performance and poor guidance when they reported recently. So we shall see. But nonetheless, the market's favouring them at the moment. Understood.
Okay, so let's talk M&A. Let's talk to rumours and movers in Europe this morning.
Okay, not so much rumours and movers today as a deal that's finally been given the go-ahead. So Imperial Tobacco up 2% nearly 2.3%. And the reason for that is that the bid by Reynolds for Lorillard, so that's Reynolds RAI in the States and Lorillard LO, the ticker in the US, has finally been given the go-ahead by the Federal Trade Commission. So these are the second and third largest tobacco groups in the US, and they're combining in a deal worth around $25 billion to compete with Altria. Philip Morris's was, for those of us with a long memory, but now called Altria, ticker MO, who are the owners of Marlboro, who have about a 47% market share in the US. It's taken the antitrust authorities in the US a year to decide if they could go ahead, but they finally said yes.
Okay.
Well, why is that positive for Imperial Tobacco? Well, for two reasons. One, because it's quite a chunky stakeholder in Reynolds anyway, and it's put about $4.8 billion into this merger. But secondly, and perhaps more importantly, as far as the London market's concerned, Imperial can now buy 4 leading US tobacco brands from the merged duo. Those are Winston, Cool with a K, Salem and Maverick, and that deal itself is worth $7 billion. So all in all, the money that Imperial Tobacco stumped up and the money it's to invest in Reynolds and the money it's now going to pay them to buy those brands. We've got about $11 billion vested interest in this deal, so quite significant. Obviously, they're not buying these brands for their European and American appeal. They're obviously thinking about the emerging market potential, which is where the growth in cigarette sales are, but certainly a space to watch. It'll be interesting to see how that merged group can compete with Altria as it goes.
Understood. Okay, so let's take a look at US data points. What should we be keeping our eyes on today?
Well, it's a thin calendar in the US as well, Nick, unfortunately. In fact, we've had to go across the border to Canada to find something of real interest, and we've got the Canadian interest rate decision, Bank of Canada speaking around 3 p.m. London time. In fairness, the expectation is for no change, so rates to stay at 0.75% in Canada. You may recall that they did surprise the market, however, with a rate cut from 1% in January, so we can't rule it out entirely. There won't be a further easing, but the expectation is not for that. Of course, people will be looking at any statement that's released for any sort of how the bank's feeling about the economic outlook in Canada, which is a bit patchy to say the least.
Okay.
And then back over Niagara Falls to America proper, and Red Book chain store sales is probably the only real figure of note. Again, this is we're looking at the year-on-year figure here. Prior read was 1.8%. The previous read to that 2.1. This comes out weekly. We like to see, or the American market would like to see a higher number rather than a lower one. If it could get back above 2%, I think that would be a start. But that's what we're looking for this afternoon.
Understood. Okay, so finally, let's look at the pre-market movers and some chart levels.
Okay, well we've got a couple of luxury retailers on the board this afternoon. So Michael Kors, first of all, we've probably all seen our girlfriends and wives looking longingly in the shop window at some of his handbags.
Right.
They've moved down by about 5.8% pre-market. They reported last night. They're on a slightly different cycle to most other US stocks. They were reporting for Q4 2014. And the Q4 figures read well. I thought they looked pretty impressive. However, the devil is in the detail with these things, and their guidance for their own Q1 2015 numbers was well below forecast, with the range of around $930 to $950 million as against the forecast of north of $1 billion. So they're down, as I say, 5.8%, whereas Tiffany, another shop popular with
luxury,
ladies, up 3.5% pre-market. Sales were weaker in Q1, but they've had a massive beat on actual earnings. So they came in at 81 cents versus the street expectation of just 70 cents. So, they thrashed that. They were also very upbeat about the guidance going forward, despite some fairly negative numbers from Japan. They look very uninspiring to me, but the management seems to think that the rest of the world will be doing okay for them going forward. So, as I say, up 3.5%. And now levels to watch today. The ground moved under our feet to some extent while we were off air, so everything's changed. But as far as the FTSE is concerned, we're back just below 7,000 at the moment. So we're looking at 69.64 on the downside there, and 70.50 to the upside. Quite a big retracement in the DAX as well. So we're now looking at 11,620 on the downside and 11,712 to the upside. In the US. We picked out 2100 for the S&P on the downside and 2115 on the upside, and in the Dow 18,035 on the downside, 18,230 on the upside. Just to say, by the way, that in both of those US markets, they tested right back to their 50-day EMA lines yesterday. So, you know, if you are plotting these on the chart, do watch those levels closely, because a break below that would obviously be a negative signal.
Right.
In terms of the currencies, no bigger mover really than in euro dollar. The bias has completely retraced, so we're back down to 108.60 on the downside for the euro against the dollar, and to the upside we need to see it move back above 109.10. So, you know, several big figure changes have come and gone there in the last few days. Similar story in Australia, the dollar rampant here and the Aussie dollar suffering. So 76.20 now on the downside is the level to watch. To the upside, if we got through 77.47, you could probably round that to 77.50 if you wanted. That would be an interesting level on the upside. And then we come to our old friend dollar yen, and finally
ticking up.
Yeah, the yen's given way finally. Not really sure what the catalyst was for that, but perhaps we just put it down to dollar strength generally. But 123.13 now is our downside level to watch, and to the upside 124.20. And you've got to really look at long-term charts to dig these levels out now, because we're at prices we haven't seen for sort of almost 5 to 10 years. And in cable, well, 153.54 had downside level, and to the upside 154.40, a slightly tighter range in that one. I think it's really, the pound's really trying to find its feet.
It strikes me everywhere. US dollar looks to be trying to go stronger and better.
Does, yeah.
Understood. Okay, Darren Sinden, market commentator, Admiral Markets. Thank you for the Wall Street crossover show. We'll see you same time tomorrow. That's 1 o'clock. Have a good day. Thank you.